What if I told you the most boring investing strategy in existence, one that requires almost zero skill, zero research, and zero excitement, consistently beats the vast majority of professional investors who do this for a living? Not just sometimes, not just in the good years, but consistently, over decades, across markets, in almost every country on earth? Today we're going to talk about why the slow, steady strategy of buying and holding broad market index funds is one of the most proven wealth-building approaches in history, and why the people who stick to it through the highs and the gut-wrenching lows are the ones who eventually win. Welcome back to Compounding with Callie, where we compound the miles and our money. Let's start with the professionals, because this is where the story gets surprising. There are thousands of highly educated, incredibly well-resourced fund managers on Wall Street whose entire job is to beat the market. They have research teams, proprietary data, decades of experience, and access to information most of us will never see. And yet, 65% of large-cap fund managers failed to beat the S&P 500 in 2024 alone. That's almost 2 out of every 3 professional stock pickers losing to a simple index fund in a single year. But here's where it gets even more striking. Stretching the time horizon out, and the numbers get even worse, not better. After 10 years, 84% of large-cap fund managers underperformed the S&P 500. And after 15 years, there was not a single category out of 22 tracked where the majority of active fund managers outperformed the benchmark. Not one. And Morningstar found that just 21% of active strategies survived and beat their index fund counterparts over the 10 years through June 2025. That means nearly 80% of professional fund managers over a decade lost to a fund that simply tracks the market and does nothing else. Apollo Asset Management put it even more starkly. Between 80 and 90% of active fund managers globally have underperformed their benchmarks over the past decade, regardless of strategy. And remember, these are the professionals. If the experts can't reliably beat the market long term, what does that say about the average person trying to pick individual winners from their phone? So why does this happen? It comes down to a few things that compound against active fund managers over time. First, the fees. An actively managed fund charging 1% per year more than an index fund has to beat the market by 1% every single year just to break even for the investor, before adding any actual value. That hurdle, repeated annually for over decades, is enormous. Second, no one can consistently predict which stocks will outperform. Markets process information from millions of participants simultaneously. The moment a piece of information becomes public, it's already priced in. The edge that active managers are trying to exploit largely doesn't exist in a persistent, repeatable way. The index, on the other hand, doesn't try to be clever. It just owns everything, keeps costs at nearly zero, and captures whatever the market returns. And over a long period, that's been a lot. Now here's the part that's important to actually sit with, because knowing the strategy works and having the discipline to execute it are two completely different things. Buying and holding index funds sounds simple, and it is simple, but simple does not mean easy. There will be days, and eventually as your portfolio grows, there will come a time when your account drops by thousands of dollars in a single session, then tens of thousands. If you stay the course long enough and build real wealth, there will be days your portfolio moves more in one direction or the other than most people make in a month. That is not a sign that something is wrong. That is the market doing what the market does, moving. And the correct response, almost every single time, is to do nothing. The investors who build real wealth are not the ones who reacted the fastest or traded the most. They're the ones who bought consistently, held through the volatility without flinching, and never confused short-term noise with long-term direction. The strategy only works if you actually let it work, and that means keeping your hands off when every instinct is telling you to do something. And here's where this all leads, because there is an endpoint to all of this, and it's worth keeping in mind on the difficult days. The goal of consistently buying and holding broad market index funds over decades is financial independence, a point where your portfolio, the nest egg that you've been quietly building through every market swing, becomes your source of income, where the money works for you instead of the other way around, where you wake up and the market going up means your net worth grew while you slept, and the market going down is just a sale you'll recover from. That day doesn't come from trading. It doesn't come from finding the next hot stock or timing the perfect entry. It comes from the boring, consistent patient accumulation of index fund shares over a long period of time. Every contribution that you make is another brick. The portfolio goes up It goes down, you add more bricks. And then one day you look up and you realize you built something that can carry you. That's the whole strategy. Buy broad market index funds consistently. Hold them through everything. Don't sell when it drops. Don't get clever when it's up. Keep your fees as low as possible and your time horizon as long as possible. Let the math, the same math that has beaten 80 to 90% of professional fund managers over the last decade, do the work for you. It's not exciting. It's not going to make a great story at dinner. But the data is as clear as it gets. This works. And the investors who stick with it long enough don't just beat the market. They eventually stop needing to worry about it at all. Thanks for tuning in. Same pace next time. Keep compounding.